Well, hello everyone. Welcome to Getting Started with Technical Analysis. My name is Barbara Armstrong. I'm a coach with Schwab and a senior manager. And I have Rachel Daschle with us here in the chat today. She is a coach that has just officially joined our team. We are thrilled to have her. And she has qualifications coming out the wazoo, is a really strong addition to our team. And so look for her in October. She's kind of doing some things behind the scenes. Today she's in the chat, but starting in October, she'll be teaching some classes. And I'm thrilled for you guys to get the opportunity to meet her and learn from her. So that's some news if you haven't run across Rachel already. If you come to Dallas this weekend, Rachel will be there and you'll have a chance to meet her there as well. And I believe she's going to be in Chicago as well that first weekend in October. So exciting things happening in our little coaching world here. Today in this class, we're going to talk about divergences and what can divergences might mean or how you might interpret that information. And we're going to look at divergences on the MACD. So if you're not sure of what the MACD is, you have no clue as to what a divergence is, not to worry, you're in exactly the right place. We're at, let me just go through this important information and then we'll look at the schedule for this class. But this is an introductory level class, so you are in exactly the right place. Just know that we're going to look at some example charts and place some example trades today, but just know that everything we cover in this class is for general information purposes only. None of it to be construed as a recommendation on the part of Schwab or myself to trade any particular pattern or strategy. Know that if you look at options, those carry a high level of risk and aren't suitable for all investors. We use the Paper Money software application for our examples and to look at the charts on the thinkorswim desktop platform. And so that's what we'll be using today. And if we do put a stop order in, know that that doesn't guarantee that we'll get out at a particular price. So we kind of revamped this series at the beginning of the year, and it is a 9-week rotation. And here we are in week 9, everyone. And next week, I'm going to do something that I used to do in Getting Started with Options, which was, you know, the things I wish I'd known when I started trading, and we'll wrap the series up with that. And so sometimes what I'll do is I'll add a bonus week or, you know, sometimes a bonus 2 weeks. We did one on Fibonacci's. And so on occasion, you know, we'll sneak in an extra one into the series. And so stay tuned for next week. We'll have a special week 10. But today, divergences. Now, I mentioned Dallas coming up this weekend. We're going to be at the Gaylord in Grapevine, Texas, and this is shaping up to be the biggest event we have ever done. If you have not already signed up for this event, I don't think it's too late, but it is a chance to link arms with all your friends that are in the world of trading, you know, and investing in the Dallas area. So be there, be square. We'll have the coffee on, we'll provide breakfast, we'll provide lunch and a great reception at the end of the day. We'll even pay for your parking if there's a parking charge. You just have to get yourself to the Gaylord the Gaylord Texan, and we'll be delighted to see you there. If you're there, please come up. You know, please come up and introduce yourself. Maybe we can take a picture together. I'll post a bunch of pictures on X. And then 2 weeks later, we're going to be in Chicago doing the same thing. And we go from what's happening in the markets globally down to looking at individual stocks and everything in between. We talk about tariffs and interest rates and, you know, how that can impact different sectors and all of that stuff. So, you know, great. It would be great to have you on board. And then Rachel is going to be in Orlando along with Mr. Ben Watson, you know, for a 2-day event at the Orlando World Center Marriott. I'm heading home for Canadian Thanksgiving. All right. So we're going to review a couple of indicators. We're going to look at what a divergences are, and then we're going to look at some examples on the charts and then discuss some example trades. Okay, so that's kind of what's on the menu here. So here's an example of a momentum indicator. And this one is called the MACD. It stands for Moving Average Convergence Divergence. You know, about the only time I ever say that mouthful is in this class. You know, otherwise I just, I just think of it and in fact call it the MACD, which is what you'll hear other people in this industry calling it as well. And it uses two moving averages. Now, what are the moving averages? It's a 12-day and a 26-day moving average. And this is an exponential moving average, which means it gives more weight to the more recent days in those averages. So it's a way of showing, you know, possible short-term changes in momentum. So that's why it's called a momentum indicator. And this line here is called the signal line. Okay, and so we're looking, you know, for how this moves back and forth across this signal line. Okay, and when would we call something a divergence? Well, if we have something uptrending like we have here, and yet on the MACD we're seeing it fall, we consider that to be a divergence. And then it happened again here. You know, and so this divergence in some ways didn't follow through. And, you know, what this is indicating is that there may be a decrease in the interest in taking this stock further. The buyers may be getting a little fatigued. But, you know, and then we had the same sign appear here, you know, where here was our high, and yet this continued to go higher, and this pulled back. And so this is what we call a divergence between the trend on the chart and the momentum we're seeing in the indicator. And just since we had that on our chart. And then we have something called an oscillating indicator, and probably one of the most popular or commonly used oscillating indicators would be the relative strength indicator. And so, you know, and a lot of people just call this the RSI. And it goes from 0, a low of 0, which is off this image, up to 100. And they'll have a line often drawn along the 30, a signal line at the 30, where if it goes below the 30, we say it's oversold. And the other line is at the 70. And when it's above that, some might look at this as being overbought. And again, if we have something like we, you know, had here where this is continuing to increase and this is increasing, well, that's not a divergence, is it? You know, but this here was coming down, and you know, we didn't see, well, you know what, we'll look at another example because this kind of got cut off here on this image. So a bullish divergence is, you know, and we call this a bullish divergence when a stock is downtrending. And while that may seem counterintuitive, it's like, I'm sorry, the stock is downtrending. Why would you call this a bullish divergence? And it is because we've got this moving up. The divergence is happening on the indicator, where this is moving up while the stock is moving down. And so the idea is that this might be a signal, sorry, there we go, that the downtrend may be losing strength. And in fact, that's what we saw happen. You know, this divergence happened, and then this stock, you know, started to move to the upside. Okay, I don't know why I didn't. I need to reboot my system. I'm not going to do it mid-class, but okay. Yeah, if you make your signals wider, these are the defaults. So if you load, you know, RSI, this is what the default is. And here's how I look at it. And one, this is an introductory level class. But I got introduced to the world of investing and trading in 2011, so it's been a hot minute. And I think they probably choose these levels for a reason. And maybe I don't have to question why a stop sign is octagon shaped. I just know that it means stop. And likewise with some of these indicators, I don't spend a lot of time trying to determine why they came up with 30 and 70. I just assume that there were good minds at work that came up with those levels, and I roll with it. But some people are curious or might find that different numbers work better for them. And that's their prerogative. So a bearish divergence is when we have an uptrend on the chart, which again may seem counterintuitive, but what we're looking for is this divergence, this bearish divergence on the MACD, where we had a stock come up and hit what was at that time a new high, and yet we're seeing a lower high on the MACD. And so it can be a signal that this uptrend is losing a little strength. Okay. And is this a sure thing? Yeah, the only sure thing is, as they say, death and taxes, right? So yeah, no, it's not a sure thing. Okay, so we're going to come out to our charts, and we're going to start with CRWV, CoreWeave. Now you're hearing a lot of people talk about CoreWeave, and this is a year-to-date chart, but if you come and hover over the first candle, March 28th. Well, what happened to January, February, and the first part of March? This just IPO'd or became publicly traded on March 28th. And as you can see, it took off pretty dramatically. I mean, it went from a low here of 33 up to 187. But now we've seen this downtrend, right? So it went from 187, it's now trading at 118. But what are we seeing on the MACD? Let me just make the MACD a little bit bigger. So we're seeing this, like if I come down from this day, where it was uptrending, it came down. So that's a match because this was coming down. But then, once we get here, which is about here on this chart, this is continuing to downtrend. But what's happening on the MACD? It's uptrending, saying, hey, this selling momentum may be waning. And so, what might you as an investor, a potential investor or a trader do? You might say, well, this line appears to have been acting as a bit of a ceiling, and it kind of came up yesterday and came close. It came here kind of, and support and resistance are ranges, right? But we could say, well, hey, if this breaks above this, like let's say it gets up to, and let me just change my drawing tool. Let's say it goes above that high, breaks above that line. 120, today's high was 125.76. So this line has synced to this. So let's say, what if it goes, $1 above that? Maybe we want to buy some shares of stock. Well, how could we put that order in? Well, we could come to our trade tab, say this divergence, it may not, it may not follow through, but we could come up and say, hey, we would like to buy shares, but I want to, and I'm willing to buy them at the market price, but only if it goes above, today's high was 125.76, I want to buy 100 shares only if it goes above $1 above that, 126.76, which means it's gone above 125.76, which means it's gone above that diagonal resistance line. Now, could it go above and just hit it and then come back down? It could. But if we wanted to put in a potential order, you might say like, hey, I'm going on a little vacation, or I'm celebrating my birthday. I may not want to look at the market. So I want just something to be ready to go. So you could put this in and it says buy 100 shares of CoreWeave if and only if it goes at or above. Oh, I meant that was supposed to be 126.76. Okay, so I'm going to come back to my sprocket, back to my conditional order. We want to make that 126, not today's high, but $1 above that, 126.76. We're going to save that, confirm and send. So now if this goes above 126.76, we're in. Now you might say, well, Barb, that's crazy. Like if I think that this MACD divergence is giving me an indication that this downtrend may be complete, why wouldn't I want to buy it now? Well, because not all divergences come through, like result in a change in trend. You know, so that's why we're doing this conditional order. Okay. So we're going to, and this would be a growth stock if we added it to our portfolio. So we're going to hit send. Okay. Now, what else might we have done? Well, we could have come up here and we could have right-clicked on this and come down to create alert and said, you know, I actually have a small account, so I don't know if the options are heavily traded on this or not, but you know, I wouldn't buy 100 shares, I might buy 5 shares, or I might look at doing another type of bullish option strategy, like a long call vertical or whatever. So let me know if this gets to 126.44 or above. And then your note to yourself, and this is just from you to you, you don't have to worry about your spelling or punctuation or any of that, potentially bullish trade. So somebody said, you know, maybe we want to do a covered call. You know, there's lots of premium. And we talked about covered calls earlier today. So I'll pay you when I see you, because our next trade, I thought we might do a covered call. And you know, so but you might say, well, a covered call sounds interesting. Please tell me more. Well, this like heavily traded 23 million shares today. And if we come out to October and we looked at the 130 call, we'd be paid 740. Why would we get so much? Because this is a very, the implied volatility on this stock, I mean, this is high. Can it go above 100%? Yes. Yeah, and so Hovis is saying, do we need a stop order? What we might choose to do is add a stop after we get in, if and when we get in. If this doesn't go up, we might not get in. And last Thursday, I covered after the close for Kevin Horner, and I'll be covering that for him, I think, next week as well. And so last Thursday, we put in an order and said, if NVIDIA goes above a certain price, please get us in. And it would appear that it has not gone above that. So if we come to the monitor tab and we come down and we look at NVIDIA, it says 0. Why does it say 0? Well, if we come up to our working orders and we look at NVIDIA, there's this market order, like the market order we just put in, and there's a wait condition. What's the condition? Well, if we click on that little sprocket and bring it up, it says, hey, we only want to buy NVIDIA if it goes above 180.48. And, you know, when did we put this order in? On the 11th. So 9, 10, 11. So we put that order in on this day to say, hey, it broke out. We had this diagonal resistance breakout, but it could pull back, and it's creating a bit of a bull flag. So our entry is currently sitting at 180.48 and it's at 174.90. It hasn't gone back above this yet. And so we might want to monitor this and then say, hey, if this goes above this day, then get us in. But, are we seeing, I didn't look at NVIDIA, but here, we've got a little bit of this seems to be more dramatic than what we're seeing on the chart. But this is a stock that has a lot of volatility associated. So this is how you can monitor a trade like the one that we just put in. Now, there was also a question about, well, shouldn't we have put a stop in? So if we come and we look at our positions, if there isn't a little chiclet beside it, with this NVIDIA one, we put our buy order hasn't triggered yet, but if it does trigger, we do have a stop in place. We have an order in just to buy NVIDIA. Now, all of these that have sell orders, it means we have a stop in place. But what about AVGO? No chiclet. No sell chiclet. Well, we might want to come up here. Now, these are organized by symbol, so maybe it just got put in the wrong spot. Like, no, there's no exit for AVGO. So then we might come out to AVGO. Nope. And say, okay, let's add an exit. And I mean, we have, and this is an unrealized gain on AVGO of $5,000. And what do we know about that $5,000? What the market giveth, the market can taketh away. We're up 16% on this, but we could end up losing money. We just gave $346 of that back today. So we bought this a while ago. So why might there not be a stop? Well, we might never have put one on in the first place, which might go against your rules. But what else might have happened? It could have expired, because stop loss orders don't last forever. Now, I don't think they ever go away actually in paper money, but if it were in your live account, it might have expired. And so we might look at this and say, well, we bought this for 309. It's now at 360. If you see, well, maybe it might act as a recent support level. It gapped up on earnings, and then it came back and hit this support level around this 335. So what if we move the stop up to 335 less 3%? That would be 324.95. So what we're going to do is come to our monitor tab. We're going to right click, create a closing order with a stop to say, hey, if this goes below 324.95, we would like to exit. Now, does this guarantee we get out at exactly 324.95? It does not. But what is the goal here? The goal is to protect some of that profit and yet give it enough room that if it pulls down for a few days, we're not being unnecessarily stopped out. So if this kind of hesitates for a few days, like it is, it's kind of going sideways. And if it then took off again, what might we move our stop up to 3% below this low here, maybe around 355? Sure. This might be part of your weekly routine. But now you can see we've got a little chiclet here, which means that we've protected this position to the downside. The goal was to protect, some of this gain. Okay, let's go look at another divergence example. So we did CoreWeave. Let's look at a bearish one. So GIS. So just as General Mills. Now, what we see when we're looking at General Mills is this has been downtrending, hasn't it? We look at this. Oh, well, let me just use this drawing tool. And you can, do this any which way but loose. Let me get rid of that. So we have here on the MACD something indicating an uptrend, but if I come here, this has been more downtrending than uptrending. And what this is indicating is that maybe this has rolled far enough down the hill and buyers are going to come in. And we've gone from 48.29, up to 49.39, but that isn't really what we'd call a dramatic move to the upside. And so might this follow through? It might. Then again, it might not. But we call this a bullish divergence. And so we're looking at a stock that's downtrending and an indication on the MACD that, the sellers might be getting tired of selling. Okay. Now let's come and look at a fruit-based stock. Well, not really. I've actually ordered the new Apple Watch. It will be delivered Friday. Not a recommendation of the stock or their products. But, when we look at this chart, what are we seeing? In September, so last week, they had their new product announcement. So, upgrades on watches and phones and laptops and all the things and services. But, what we often see with Apple is same on the earnings report, even if it's pretty fantastic, if it's not like extraordinarily over the top, blow your mind, the stock sometimes will have a negative reaction initially. And sure enough, like we saw this pullback, and then it bounced. But what we're seeing here, like if I come here, what do we have? We have this move to the upside. And what do we have on the MACD? Well, the opposite. And I'm just looking at this snippet here. And then, this came back up, like dramatic line here going the same distance, and then kind of like flat as a pancake here. And so could the winds of change be upon us? Like, are we seeing this, same kind of momentum that we might be with CoreWeave? But, CoreWeave has, this has ultimately been kind of more rolling up a hill than down. But if we wanted to buy the stock, might we look at this and say, well, it's come up, at 240 seems to be, or 241-ish, a potential resistance level. It's come up and hit this again. Tomorrow, we're going to hear some news from the Fed on interest rates. So, there might be kind of more of a tentative nature happening with a lot of traders right now. But could we look at maybe, if we wanted to buy 100 shares, maybe selling a covered call? And then if it comes back down to here, what could we do? We could buy the call back. Like, so if this goes, if this goes sideways for a while, could we be watching the MACD for signs of a divergence? But could we also be looking at this, if I sell the call here, and then buy it back when it gets here, might that work out? And then if it comes back up and rolls over again, could I sell another one here? And if it comes back down, buy it back here. Now, what if when it comes back up and it comes down, and so I sell another one here, and then it takes off and it goes through, maybe I've sold the 250 strike and I'm called out. Like, are we flying the flag at half mast? No, we bought it at this price. We got out, and made some money. Maybe we sold a couple of covered calls here. We made a little money here and a little money here. And then when we got called out, we may have made a little money. Now, it could come down and break down this way also, and we could end up losing money. And that's part of why we want to be disciplined in our approach. But this might be indicating some waning momentum. And if we're still interested in this, company, how might we use that information? So if we come to our trade tab and we come out to October and we say, well, what if we looked at this 250? And if it goes above 250 and I have to sell, I'm okay with that. Or we might even do the 245. Now, when we look at the 245, we've got tons of volume on all these contracts. This stock has traded over 40 million shares today. But, at the 245 strike, we have a 35% chance of being called out, of it being in the money at expiration, a 70% chance of it coming up and kissing it. And if you're saying, well, I wouldn't mind making a little money, I'd rather the probabilities be lower, then if you sell the 250, you'll receive less money, but the probability of being called out is lower. And just because something is in the money, it doesn't mean you're immediately going to be called out. And I've actually been called out only one time, but I was called out once when it wasn't even in the money. Now, it wasn't off by much, but it's like, okay, you want to pay me $250 and it's trading at $249.50? Be my guest. So it doesn't have to be in the money for you to be called out. But if this happened, are we going to be sad? Well, let's do the math. So if we come to buy covered stock, and by the way, I filled in for James Boyd this morning in Investing Master Series, and we talked about buy right covered calls and did several examples. So if we look at this and we say, well, if we were to be called out, how much could we make? $250 a share. That's our cap. Because we've sold a call that says, hey, if you'd like to buy our shares from us at $250, be my guest. You can have them. You can buy them. And if it goes up to $260 and we're called out, how much would we receive? $250. That's it. So how much would that be? Well, it would be about $13.57 a share is the most we could make. So if we say, well, if we did make that $13.57 a share divided by, and we're live in the market, so, things are going to change a little bit. 236, call it 43. That's a 5.7% potential return for a trade we would be in for 31 days. And so if we're okay with that type of return, were we to be called out? And you might say, well, I'd kind of like to own 100 shares of Apple. Well, you could buy 100 shares of Apple and just put it in your account, but know that this MACD is indicating that, the momentum may be waning a bit, and it could have a short-term pullback, could have a long-term pullback. And then how might we protect ourselves to the downside? Well, if we're taking a longer term approach, and we might say, well, I'm going to come back to this 224, because if it comes down and bounces, I don't want to end up getting stopped out just before it gets here. So I may take that 224.62 and go 2% below that. So that's at 220. And what are we paying to get in? We're paying $236. So you're risking $1,600, to potentially make $1,300. But the reason you're putting your stop that low is that because it's then below what looks to be a support level. And so we would put it in this group. To put this exit in, we're going to come to single order, make it a first trigger sequence. We're going to right click, create an opposite order, and we're going to make it a market order. And you'll see here, we're saying we want to buy back this call. Don't know quite what it'll be worth, but we want to buy it back and then sell our shares. And we only want to do this if Apple goes at or below 220.12. So you might say, well, what are the odds of that happening? Well, I'm glad you asked. And where could I find that information? Okay, that's another good question. So I'm going to send that in. And then, so we're looking at this option chain. We're looking at a trade where we might be in for 31 days, right? We're selling this call at 250. Our stop is basically at 220. So if we come here and we say, okay, our stop is at 220, could I use the option chain to give me an idea of what that probability is? And the answer is yes, you can. So if we come and look at this 220 strike, also expiring October 17th, and we look at the probability of it being in the money, and this probability of TO is probability of touching. What it says is you have a 14% probability of it being below 220 at expiration, but more importantly, your exit will be triggered if it even just touches it, if it just kisses it for just like un moment, like it touches it and then goes back up, it will trigger your stop, and you've got a 28% chance of that happening. So imagine if you put your stop $8 below where it's trading at 230 instead. Now you have a 58% chance of it kissing that with where it's sitting now. And it might not come down. You've got a 42% chance that it won't. And here you have like almost a 72% chance that it won't even come down and kiss it for a minute. And that's what we want. We want to preserve our ability to stay in the trade, right? Right. So if you'd not thought of using the option chain that way, I just think it's kind of a cool little tool that we can have. Okay, so let's look at Airbnb. There's another potential example. I just have to close my drawing tool. So Airbnb has been kind of trading in this range, hasn't it? You know, but we saw here, you know, it hit a low and then it came back and it hit really a pretty similar low, didn't it? Well, sorry, I'm not drawing my line very well. But, you know, when we look at this, that's a pretty dramatic, you know, this is not, you'd think that this low would be closer to here, you know, or not there yet. Okay, okay. So you would think, here's where our line is, you would think that the lines would be more like this and that this would have come down closer to here, but it's not. You know, so sometimes, you know, these things, you know, they just require kind of a nuanced look at things. And so how might a trader look at that? Well, they might say, well, you know what? I'm going to do a swing trade. The other thing is that we have this candle pattern here. And if we zone in and look at it, this candle pattern at a potential support level is called a harami. And this is a bullish harami where today's candle is totally inside the body of yesterday's candle. And this candle pattern does not require confirmation. So what some traders might do is see this divergence on the MACD, say, you know what, I'm going to buy 100 shares and I'm going to put in a target at this previous high around 130, kind of do a swing trade. And, you know, so if I can buy this now at 121, sell it at 130, you know, I could make $9 a share. And, you know, just short-term trading strategy. Or could we sell a short put vertical if you're an option trader? Or, you know, there are other things that we might consider, right? Yeah, so these are some things that might ponder us to, get us to have a look. Now, just before we close, I'd like to mention that if you have not subscribed to the Trader Talks channel, you're going to want to do that. And, what you're subscribing to, it's complimentary, but you're subscribing to the Trader Talks channel from Schwab Coaching on YouTube. And let me just bring this up. So when you first come in here, what will be up is what is currently playing. So we're in getting started with technical analysis. So that's what you'll see. But if you come to playlists and you wanted to do some binge watching, say, hey, this is the first time I'm here and I'd like to watch the rest of the series rather than binging Netflix, this one is down closer to the bottom. But here's getting started with technical analysis. You can view the full playlist just by clicking here, and you'll see weeks, 1 through 9. I've also created some mini sessions, and I've done these short candlestick pattern videos. They're all under 5 minutes long. They kind of range from 2 to 5 minutes in length. And, this bullish Harami pattern is one that just went up a week or so ago. And then I've also created some example trading plans. One of them is this buy right covered call plan, or here's an example of a stock investing plan, a simple stock investing plan. And these just provide you with a framework from which you can create your own trading plan. Okay. So those are just some additional resources I wanted to point out. You're going to want to make sure that you follow Rachel and I in the Land of X. My handle is Barb Armstrong CS, and Rachel is going to post hers in the chat. And then please hit like. By hitting like, what it does is it helps move things up in the YouTube algorithms so that more people can find this content. And so I'd appreciate it if you did that. It also, as Cameron May likes to say, it sounds like applause to us. It lets us know that you think that what we're doing is worthwhile. So, we covered divergences today. Next week, I'm going to talk about the 7 things I wish I'd known about trading when I kind of got started. Because for me, looking the first time I saw a chart, I was just enthralled. And, some traders, trade based on fundamentals and an in-depth look at the company, and there's a lot of validity to that as well. But when you look at a chart like the S&P 500, and you can just see how price is moving over time. I was so excited, my car could have driven itself home. So guys, have a great rest of your day. Lots of great content still to come. I hope you'll stick around and join us for that. Tomorrow, trading price patterns at 1 o'clock Eastern. I will see you then. Take care, everyone. And thanks for the guys behind the scenes bringing this class to life, and to Rachel and Scott Thompson who have helped out in the chat. Bye for now.